Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about risk to reward, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
Everything that we do is about risk to reward and asymmetry, and we're adjusting always to volatility mostly, and we're choosing between a risk to reward that is between one range and another. Our minimum or our optimal risk to reward, over at least that I've seen, is somewhere between 7.5 and 12 most of the time. It's somewhere in there, but you can go as low as 5 and you can go as high as 20, and that'll change over time. And so what we do is we exercise the range. We try to find the sweet spot for that market for risk to reward. The width and also the time is more of a function of whether we go 0 DTE or 1 DTE or 2 DTE is dependent almost entirely on volatility. And so let me first bring up the VIX, and I'm sure you've seen this chart before.
With the zombie land down at the bottom and
yeah, I also drew these other things in here to show this. And when volatility is super low, we trade much narrower flies. And from what I've seen, I guess you could say 0 to 3, but 1 to 3 seems to be the optimal number of days out. When it goes higher, then we can start going to 0 DTE and possibly 1 or 2 days out. These other higher days, these number of days out up here, they're still speculative because we haven't been up there to test this. But I can tell you in zombie land, this is definitely an advantage going 1, 2, or 3 days out. And we've seen that since we've started implementing that strategy. And I've also seen it with the study that we did from last August. We did about a 6-month study. So when volatility is low, we trade a range of wide flies and 1 to 2 days out, and a risk to reward somewhere around or less than 10% of the width of the fly. So if you want to put a fly on that's 20 wide, right, and you put it on, you just put it out there on your analyzer. You always stage it first. You don't just come up with it in your head and just execute it. Always stage it first and then see what it's going to cost. So let's say you decide, okay, because of its low volatility, I'm going to put on a 15 wide fly. You create a 15 wide fly, and then your next step is you don't want to pay more than 10% of the width. Now, 10% of a 15 wide fly would be $1.50. And you notice that, oh, it's $2.70. How do you make it less? You push it further out of the money. Push it 1 or 2 strikes out until it is 10% less. And then when you're happy with that, then execute it.
Okay, that's the way I've been doing it. I just didn't know whether you were taking like your volume profile and trying to say, okay, the body should be around here, and I know it's not in my ratio right now, so I'm going to wait until it does get in there.
I used to use volume profile to try to make entries, and after a while I found that it wasn't that useful. It's very useful when you're trying to get out. Get out of the trade. Very useful, but not as useful getting in.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.